Hello, here we are back again. Hope that these handouts are helping you in doing your homework. It's real important that you do those. We're learning about bonds, right? And last lecture we talked about issuing bonds at a discount. Is that correct? Issuing bonds at a discount. Actually, let's just do this real quick. It's a little refresher. When we issue bonds at a discount, the cash proceeds are less than the par value, right? When we issue bonds at a discount. And the issue price, the cash proceeds, this number will be less than 100%. So we don't get par value at the beginning, even though we have to pay that larger number of par value at the maturity of the bond, correct? And the reason that this bond is sold at a discount, for example, in this case, is because the contract or stated rate is less than the market interest rate, okay? So when that stated or contract rate is less than the market rate, we have to sell these at a discount, otherwise nobody would want our bonds, right? So, all right, so what I wanted you to do was, I believe I wanted you to finish up the tungsten one, is that correct? Okay. So I believe I showed the answers to that, but let me go ahead and put them again. You can just show this while I talk. You don't need to show me. There is that first page. Of course, this bond is sold at a discount. And I think I emailed these to you. Did you guys get those? Yep. Okay, good, good. So any questions on the first page of tungsten? Okay. Now, I talked about how we utilize that amortization table to do our interest payment journal entries, right? I think it's personally easier to do the amortization table first and then the journal entries, okay? So this is the second page. Let me show the top half. I'll show you the bottom part here in a second, okay? So there is the first 4 journal entries. And because that bond carrying value changes every time, the amount of bond interest expense is different each time, isn't it? Okay, so the journal entry will not be the same like it was when we issued bonds at par, right? Okay. All right. And so then let me show you the bottom part. I'll zoom in on that a little bit. You can see I had to use some whiteout because I actually wrote the wrong numbers to begin with. I made a mistake too, believe it or not. So that is the bottom part of tungsten, okay? This was all tungsten, okay? Any questions on any of that? You guys probably looked at that anyways. Now let's take a look at the answer to Pinkman, okay? Now one thing I want to make sure I explain before I forget is, let's take a look at this. Okay, let's read this real quick. Does this say, does your handout say the market rate is 9% and thus the bonds are sold at 81.5984? Does it say that? And then in parentheses I say thus, in other words, cash proceeds are 81.5984% times par value, okay? I want you to be familiar with that terminology, okay? For example, sometimes we will say a bond is sold at 97 1/4. What does it mean if we say a bond is sold at 97 1/4? That means it is 97.25% times par. That's what our cash proceeds would equal, okay? And if you punch that into your calculator, obviously it would be 0.9725 times par value to get your cash proceeds, okay? I'll give you another example. Let's say the bond was sold at 96.5. Okay. All that means is you take 0.965, 96.5% times par value to get your cash proceeds. You with me? Any questions on that? Okay. All right. Let's take a look at the answers to Pinkman. All right. Take a look at the top part. This is a bond sold at a discount. We know that for several reasons. First of all, that's the only thing I've taught you, right? So, secondly, the market rate is 9%. The annual, the contract rate is 7%, right? So the stated rate of 7% is less than what the market's paying. So we sold it at a discount. I've taught you selling at par too, haven't I? That's when the rates are equal. This is when the contractor stated rate is less than the market rate. Okay? All right. So how much cash proceeds will they receive? Well, we take 0.815984 times $500,000. Did you get that? Okay. So our journal entry is this. What type of account is discount on bond payable? Remind me.
Contra liability?
It is a contra liability. Sometimes people say it's a contra account. There's no contra account. It's got to be a contra something. So this is a contra liability. So it has a debit balance, right? D for debit. It's a debit balance account, correct? And we can see that when we list it on the balance sheet, we list the liability less the contra liability of discount on bonds payable, and that equals the carrying value. Sometimes we say the book value of the bond, okay? Any questions on this top part? Let's take a look at the amortization table. Now remember how we calculate this. This column, we always figure out how much the cash interest payment is by taking the par value times the stated or contract rate times 1/2 since it's semi-annual. None of those factors change, so this is the same number each time. The bond interest expense, though, does change, right? Because we calculate that by taking the previous carrying value times the market rate times 1/2. So we got this 18,360 by taking 407,992 times the market rate of 9% times 1/2. Correct? Mm-hmm. Then this is just the difference between these two numbers, right? 18,360 minus 17,500 is 860. How did we get this number? We just took 92,008 minus 860 equals 91,148, right? And then, of course, the bond carrying value is always the par value, 500,000 in this case, minus the unamortized discount. Make sense? Okay? And it works that way the whole time. So any questions on any number on this amortization table? Anybody?
So the unamortized discount is subtracted from the original bond par value, not from the previous carrying value?
Yes, that's correct. I think this is what you're saying. Yes, this column is always par value of 500,000 minus whatever this number is.
Okay.
Okay? You know, and of course, if you wanted to, on that discount, I didn't ask you to do this, but you could do a T account. I mean, somewhere in your accounting records is a T account for discount on bonds payable. We debited it for 92,008 right here, right? Correct? And we'll see on the interest payment dates, let's go ahead and show that page. Okay. I credit it for 860, okay? So now that was at, when was this bond issued?
July 1st.
July 1st, okay. So this was the entry I made at 12/31/13 above. So now that has a balance of 91148, and then, you know, the next interest payment I credit discount on bonds payable for, oh, thank you. For 898, 630, 14. So now my balance is, what is that? 9250. Okay, so that's really what's happening on this amortization table. See what I'm saying? But you're right, Luke. That's always the par value of 500,000 minus what's here. Okay, so let's take a look at those interest payment dates or journal entries. You guys get that? If you're ever off by $1 or $2, it's probably a rounding issue. I don't care. I think I told you to round to the dollar, nearest dollar on this one, didn't I? Okay. Now I ask you how the bond will look on the June 30, 2015 balance sheet. Okay. Now always make sure you don't ever assume what date I'm asking. Okay. Oh, it must be the latest one. No, go look at the amortization table for June 30, 2015. It does happen to be the bottom line, but sometimes I don't ask. Sometimes I'll ask for this one or this one or this one. So make sure you always know. That's the date I'm asking for. And at that point, par value is 500,000. The unamortized discount is 88,330, and thus that's the carrying value. Okay? Make sense? Now, way into the future, what's the journal entry to extinguish the bond when it matures? We just pay off that liability. Is that correct? Yep. All right. Now, let me give you one caution on the test. On the test, when we take it, I am going to give you the amortization table, okay? I'm not going to give you how we compute each one of those items, though. Okay, you'll need to know that. Okay, but I will give you the table, and it'll be in the same order. But some of these handouts, I ask things in the same order. I ask, what do we issue it at? What's the cash proceeds? What's the issuance journal entry? You know what I'm saying? Read the test carefully, because I think I ask them in a different order, or I don't ask as many questions, so I've gotten rid of some of them. So some people will just, without even thinking about it, they'll write the journal entry, for example, for the issuance right there, even though that's not what I'm asking for on the test. Does that make sense? So make sure you don't just, oh, I know what he's going to ask here. No, go ahead and read the question. What am I asking you to do? Okay? All right, any questions on the Pinkman handout? Did it go okay? Okay, what I want to do now is, before we move on, I actually want to take a few minutes and work on the next one in your bond packet, which I believe is, correct me if I'm wrong, is it Gustavo? Okay, I don't know if you'll have time to do the whole thing, but we're going to go ahead and just take a little time before we move on in this lecture and get a little bit more practice. Let's go ahead and work on Gustavo for a few minutes while they roll the wonderful music that you all enjoy so very much. Okay, I'm not sure if you're done, but let's go ahead and at least take a look at the first page. Of course, you folks at home, I hope you guys, when we take this time and the music plays and everybody here works on it, you work on it too. And if you want, you can finish it up and just push play when you are done. So, I won't read this to you because you just read it, but let's go ahead and take a look. Now, I did ask you for this one to round to the penny. Okay, and I'll tell you why here in a few minutes, but most of you, I think all of you at least got this first part done, didn't you? Okay, is that what you all got? Check my answers. Keep me honest here. Okay, any questions on that? Okay, now I want to look at the amortization table, and let me zoom in on that as much as I can. Again, I had you round to the nearest penny. The reason I had you do that is because for this bond, I don't always do this, but this was only a 2-year bond, is that correct? This is only a 2-year bond. Is that right? So you see the entire amortization table in front of you, since it's only a 2-year bond. This is the maturity date, December 31, 2015. So, this row is usually forced, okay? So what you might have done is you might have gone through this and then got like a slight number there, like a $2 or $3 or something. That's just a rounding issue, okay? Because we didn't go out to the, 8 decimal places. But at the maturity date, the unamortized discount should be 0. Thus, the bond carrying value should be par value, whatever par value is. In this case, it's $50,000. So a lot of times you have to just, here's, I guess, the way I would have thought through this. Since I knew the next date was last, well, that's how much discount I have to amortize for the last one. So I would have just forced that number. That number would be the total of these two numbers, and thus this would be 0, and this would be 50,000. Are you following me on that? Now, if you get down here and you haven't rounded, or you've rounded, and this is a really high number, 12,000 or something, that's not a rounding issue. That's just an error. But if it's just a few dollars, okay? Now, let me point out something. Recognize that, like when we did, let me show you Pinkman again. When we did Pinkman, that doesn't go to 0. That doesn't go to par, right? Why? Because what?
We're not all the way done with it.
Yeah, we're not all the way. This is a 20-year bond, and I just had you do the first 2 years, right? I just didn't want to make you do 20 years of an amortization table, correct?
Thank you.
You're welcome, okay? But some people on a test, I'll give them a 20-year bond, and by golly, they get so frustrated because they think that's got to be 0. This has got to be par. No, this is just the first 2 years of a 20-year bond. So in the case of Pinkman, that's not the case. But in the case of this one, where it was a 2-year bond, you'll have this go to 0 and this go to par. Cool? Let's take a look at the second page for those of you who got to it. Okay. Well, show you the top part first. Okay. And of course, you make this from your amortization table, right? Okay. Anybody get those? Verify those?
Yep.
Yeah? Okay. And then the last interest payment that we do is December 31, 2015. And then, of course, we skip a lot of interest payments and to do the journal entry at the maturity date. Okay? All right? So if you didn't quite get that one done, you can finish that up later. All right? Any questions on that? Okay, what I want to talk about now is the next part of this lecture. We haven't done much from the book, textbook, have we? I don't know. I like the way I teach this better than the way the book teaches it. So I think we hardly have any textbook homework in this chapter. So, okay, what we're going to talk about now is, well, before we talk about what we're going to talk about, let's do a little refresher. When the contract rate equals the market rate. The bond is issued at par, right? And the situation is like with Ecclesia, right? The handout we did. When we issued a bond at a discount, the market rate was greater than the stated rate or contract rate, right? The market rate was higher, so we had to sell it at a discount. Now we're in a situation where we're going to look at what if the market rate is below the contract or stated rate. You with me? Or said the other way, what if our stated or contract rate is greater than the market rate? You with me? And that's going to be what we're going to talk about now, and that is called issuing bonds at a premium. Issuing bonds at a premium. Now, this is going to seem real similar because of the way I teach discount, because a lot of what I said with the discount can be used here. It's just kind of a mirror image. But take a look, and like when I taught issuing bonds at a discount, it's really better to almost just do an example as I teach it. So that's what we're going to do. Okay, we have a bond here issued on January 1 of 2014 for Hyacinth Company. The par value is $100,000. Okay? Now, jumping down to these contract and market rates. The contract rate is 12%. Yet the market rate is less than that. It's 10%. So we have this situation down here at the bottom. If the contract rate is above the market rate, we sell this bond at a premium. Okay? So we know just by looking at these two rates that this is a bond sold at a premium because the market rate is lower. Now we also know this because the issue price is greater. It's greater than 100%. Are you with me? It's greater than 100%. Now before we go on, what I taught you earlier in this lecture applies to this one as well. This says the issue price is 103.546 of par value. The other terminology might be is the bond is sold at 103.546, which just means you take 103.546% times par, right? Well, if you punch that into a calculator, it's 0.03546. Yeah, thank you. 1.0, let me say again. 1.03546 times par if you're punching it into a calculator, correct? So if I said instead the bond was sold at 105 3/4, that means the bond is sold at 1.0575 times par is the cash proceeds. Okay, so I just want you to be familiar with how that's sometimes stated. Okay? All right, back to the computer though. Let's take a look at this bond. Okay, so the stated rate is 12%, the market rate is 10%. Again, it's a biannual, or I'm sorry, semi-annual. Said that wrong. It's paid semi-annually, interest is. Means every 6 months, twice a year. So interest is paid semi-annually, and it's a 2-year bond. It's a short bond, so we'll be able to see the whole life of it. Okay, well, let's go through and do the journal entries for this bond at a premium. First, the cash proceeds. The cash proceeds are the par value of $100,000 times this 103.546%. Now, again, I'll give you that number. You don't have to worry right now about how I get that number. Okay? So the cash proceeds are 103.546. So we're just selling this at a premium, folks. Here's the deal. At the inception of the bond, when we issue it, we're getting $103,546. But we only have to pay back par value, which is $100,000. So we're receiving more money at the inception than what we have to pay back at maturity. Just the flip-flop. You with me? Okay. So we have a bond premium in this example of 3,546. And we are going to amortize that just like we did the discount. Okay? Let's take a look at the issuance journal entry. Journal entry number 1, sometimes I call it. On January 1, they would record the bond issuance as follows. Well, it's the same methodology, folks. We debit cash for the cash proceeds, 103.546. Remember, we are the issuing corporation, right? We're not the individual investor. So we debit cash for 103,546. We credit bonds payable for 100,000. Okay? Well, that doesn't balance just those two items. So what we have to do is we have to credit premium on bonds payable for 3,546. Now think back to when we did a discount on bonds payable. A discount on bonds payable was what type of account? A contra liability with a debit balance. A premium on bonds payable is what we call an adjunct liability with a credit balance. What does the word adjunct mean? I think it means like alongside. Okay? So, the premium on bonds payable, and you know I love to ask this on a test. What type of account is it? It is an adjunct liability account, and it has a normal credit balance. Now, how does this look on the balance sheet at issuance date? Well, remember how for a bond sold at a discount, we subtracted the discount? Remember that? Since it was a contra liability. With a premium, since it's an adjunct liability, we add it. So you've got your bond payable of $100,000 plus your premium equals your bond carrying value. You with me? It's just kind of like holding a mirror up to what we did with the discount. And again, we're going to use the effective interest rate method in this class. We don't use the straight line method. What's the interest payment for the first interest payment date? Well, let's go ahead and build the journal entry the same way we built the last one. The first thing we did was how much do we credit cash for? Well, once again, you credit cash for par value times the stated or contract rate times 1/2 since interest is paid semi-annually. Isn't that exactly how we computed that for bonds sold at a discount? Okay? So that's the first thing you do in the journal entry. The second thing that you do in the journal entry, once again, is we debit bond interest expense. For how much? Once again, it is the previous period carrying value times the market rate times 1/2. Isn't that how we computed bond interest expense when bonds were sold at a discount? Yep. Okay? And once again, once you do this first and second thing, then you ask yourself, does the journal entry balance? And it doesn't. So you have your accounting plug here. And this time, instead of crediting a discount, you're going to be debiting a premium. And this should make sense because premium on bonds payable is a credit balance account. Thus, by debiting it, we're amortizing or decreasing it gradually. Does that make sense? Okay. How does the amortization table look? Same way, except this time the bond carrying value is the par value plus the unamortized premium. Okay? So note, at the issuance date, the unamortized premium is 3,546. Carrying value is thus 100,000 par plus the unamortized premium of 3,546. Okay? These columns are computed the same way. Interest payment is par value times the contract rate times 1/2. Interest expense is the prior carrying value times the market rate times 1/2. So this interest expense is 5,177 is 103,546 times the market rate. What was the market rate on this? 10%? 10%. Times 1/2. Okay? And how did we get this number here? Well, 3546 minus 823 equals 2723. 2723 minus 864 equals 1859. And again, we're seeing the whole amortization table because this is only a 2-year bond. So at the end of the bond's life, this should be 0. You might have to force a few numbers there. And the carrying value is 100,000. It started above at 103,546 and gradually goes down to carrying value. You with me? So come off that for a second. With a bond sold at a discount, the carrying value started below par value and it gradually rose up until they equaled. With a bond sold at a premium, the carrying value is above par value and it gradually comes down until they're equal. All right? So, and then of course, when you pay off the bond, I don't show this on the slides, but you make the interest payment date, the last one, whatever that is, and then of course you pay off the par value. Okay? So that's the journal entry when we extinguish the bond. Okay? Does that sound good? Gosh, I wish we had one in class we could work on as an example.
Too bad.
We do. We do have one we can work on as an example. And it is called Goodman. Goodman. Okay? Let me show that real quick. So you folks at home, again, I always want you to work on the same thing. We're going to be working on the Goodman handout. It's a front and back 2 or 2 pages. Okay? So let's work on Goodman Company bond handout while they play that music. Okay? Okay, you guys are probably not done. You folks at home, you can pause this and start this up when you are. Go ahead and show this while I talk. I'm just going to show you some of the answers. I'm actually going to show you all the answers, but for you folks here, I will email you the answer, the complete answer to Goodman, okay? And you folks at home, you can either look at it here as I show it, or you might look in the back of your handouts where I have selected answers to problems and see if it is there. These columns are filled out the same way, right? Doesn't this kind of seem similar? Okay, that's why I teach it that way, Daniel, okay? Because it should be pretty easy to move from a discount situation to a premium situation. And then, of course, once you have the amortization table filled out, you can use it to do your journal entries. There's 6A, 6B, and 6C for Goodman. Okay, take a look at those. And then there's the bottom half of this page. Okay, remember we add the premium, don't we? Okay, cool? All right, so what I want you folks to do, I want everybody to do for homework is the following. I want you to finish the Goodman handout if you haven't done that, and then look at the answer to the Goodman. And then I want you to do that last handout in the bond packet, which I think is Schrader Inc. Is that correct? Schrader Inc. handout. Do both of those pages. And then I want you to read page 568 in your textbook and do Quick Study 14.8. That'll take you about a minute. Okay? Now so that's the homework I want you to do for next time. Okay? You can come off that if you would for me. Hey, we're going to start chapter 16 next time. One of my favorite chapters to teach. But after chapter 16, we have a test. So next period, I'll get more specific on when that test is going to be, but kind of know that it is starting to get to be that time again. All right? Any questions, folks? All right. Remember to look at those red calendar due dates online, folks. We'll see you guys later.